Growing a business into multiple entities means multiplying your paperwork. Suddenly, you have distinct general ledgers to balance, separate vendor lists to maintain, and unique tax obligations to file for every single location or LLC. The default move for most founders opening their second or third entity is to just buy another subscription to whatever accounting software they already use. But as you scale past two entities, those separate logins create isolated data silos. You can no longer see your total cash position or unified expenses at a glance without manually logging out of one account and into another. Because the systems don't talk to each other, finance teams are forced to export everything into spreadsheets at the end of every month just to build a combined financial picture for investors or the parent company. Adding basic software subscriptions linearly creates an exponential increase in manual administrative labor. The system usually breaks down when entities start frequently doing business with each other. Shared services, management fees, and inventory transfers between your own companies create a tangled web of payables and receivables. This chart maps cost and labor on the y-axis against operational complexity on the x-axis. If we plot the total number of business entities against the hours required for end-of-month reporting, the line stays relatively flat for the first few companies. But watch what happens when the entity count hits 4 or 5. The manual spreadsheet work becomes mathematically unsustainable, and the time required to close the books spikes. Every manual data entry and formula adjustment during that end-of-month scramble introduces the risk of errors. A single misplaced decimal in an elimination entry can skew your combined revenue figures and trigger costly tax mistakes. Preventing this breakdown requires matching your exact entity count to a software platform equipped with native portfolio-level reporting. At the base layer, Tier 1, we have micro-entities, freelancers, and service businesses operating 2 or 3 straightforward accounts. Platforms like FreshBooks excel here. They keep individual entity time tracking, project accounting, and client invoicing strictly isolated from one another. The trade-off is clear. You get an absolute baseline of simplicity and low costs, but you give up any ability to automatically generate unified portfolio-level reports. Growing franchisees and small holding companies usually move to Tier 2, which consists of the industry standards, QuickBooks Online Advanced, and Xero. This matrix compares software tiers. Looking at Tier 2, you'll see a linear cost multiplier. QuickBooks charges around $100 per month for every separate company file, and Xero operates on a similar per-organization fee. Paying that multiplying subscription fee buys you integration with thousands of third-party apps, unlimited user access on platforms like Xero, and a standardized interface that any certified public accountant already knows how to navigate. Yet both platforms lack native auto-consolidation. To combine your ledgers, you either have to export everything to Excel or pay for expensive third-party reporting add-ons like Fathom or Sift Analytics. Cloud browser isolation tools, which run web sessions in sandboxed environments, can remove the daily friction of managing multiple logins across these accounts, but they can't force the disconnected data silos to merge. Tier 2 software prioritizes familiar interfaces and manageable monthly costs, but it ultimately sacrifices unified financial intelligence. Operators managing 5 to 15 entities face a different reality. They deal with complex shared resources, regular inventory transfers, and heavy intercompany transactions. This volume of internal traffic requires a mid-market enterprise resource planning system, or ERP. Sage Intacct is the standard purpose-built multi-entity platform calibrated for this specific tier. Back on our matrix, Tier 3 introduces a major technical upgrade: real-time, fully automated financial consolidation across every single entity under your umbrella. The software automatically flags and eliminates internal intercompany transactions during consolidation, ensuring those internal transfers don't artificially inflate your combined revenue and expense reports. Accessing this automation requires a steep upfront investment. Implementations can take months, and annual contracts easily run between $15,000 and $25,000. Mid-market ERPs command that price tag strictly because of the hundreds of manual labor hours they eliminate and the severe audit risks they prevent. The extreme end of the scale belongs to Tier 4 operators managing 15 or more entities across international borders. Operating at this scale usually points directly to Oracle NetSuite's One World module, an enterprise-grade solution built for infinite subsidiary expansion. NetSuite instantly executes multi-currency conversions across dozens of different international jurisdictions, pulling localized data into a unified reporting currency without manual calculations. It also dynamically manages conflicting global multi-tax codes from a single database, keeping every subsidiary compliant with its local tax authority. Deploying a system this massive creates absolute vendor lock-in. It requires a dedicated team of internal financial operations staff just to maintain the architecture and manage user permissions. When you reach the global enterprise scale, the cost of the software subscription is secondary. Systemic capability and strict regulatory compliance become the only metrics that matter. Selecting the right platform comes down to matching your current entity count and transaction complexity to the correct tier. This flowchart maps the decision. If you operate 2 to 4 simple entities, the math points to accepting the separate subscription fees of Xero or QuickBooks and managing your consolidation manually. If your portfolio grows to between 5 and 15 entities with heavy intercompany transfers, you have outgrown manual spreadsheets and must upgrade to an automated mid-market platform like Sage Intacct. And if you are running international subsidiaries subject to multiple tax codes, a global ERP deployment like NetSuite is required to maintain compliance. Buying more software than you need burns critical cash flow, but running too many entities on basic software destroys your long-term data integrity. Before migrating to any multi-entity software platform, there is one absolute, non-negotiable prerequisite. You have to standardize your chart of accounts. The chart of accounts is the master list of every financial account your business uses to record transactions. If one LLC logs internet expenses under account number 6000 and another logs it under 6050, the automation features of even the most expensive ERP system will immediately break during consolidation. You must establish an identical account numbering scheme and exact account definitions across every single entity in your holding company. Executing this upfront structural standardization is the only reliable way to guarantee that your final consolidated reports will be accurate and frictionless. No software platform can automate a broken financial structure. The technology is only as effective as the systemic discipline you build around it.